Success in investing is not related to IQ. What you need is a temperament that helps control the impulses that cause other people to make mistakes. Warren Buffett. This quote from Buffett reveals one of the most valuable secrets to building wealth: emotional and financial discipline. In the world of investments, it is not the smartest or the fastest who achieve success, but the one who can remain calm, make rational decisions, and follow a consistent strategy over time. Discipline is the foundation upon which great fortunes are built. Without it, even the best opportunities can be wasted. But why is discipline so important? We live in an age of immediacy, where social media, financial news, and market trends bombard investors with information at all times. This flood of data can generate anxiety and drive hasty decisions. How many times have you heard of someone who bought a trendy stock and lost money because they lacked the patience to evaluate the investment strategically? Throughout his career, Buffett has shown that discipline is the key difference between the average investor and the one who builds a legacy. He does not get carried away by market euphoria or collective panic. Instead, he coldly analyzes a company's fundamentals and makes decisions based on concrete data, not emotions. Imagine discipline as a muscle. The more you exercise it, the stronger it becomes. At first, it may be difficult to resist the temptation to chase quick gains, but over time, the practice of patience and rational analysis becomes second nature. Buffett began investing at 11 years old and, since then, has cultivated ironclad discipline, which has enabled him to turn smart investments into a billionaire fortune. In this video, we will explore how discipline shaped Buffett's success and how you can apply these principles to build your own fortune. We will uncover practical strategies, real stories, and valuable lessons that demonstrate why discipline is not just a desirable quality, but an essential requirement for anyone seeking financial prosperity. Get ready to discover how small, consistent, and controlled decisions can yield extraordinary results over time. After all, as Buffett teaches us, building wealth is not a sprint, but a marathon, where discipline is the steady step that leads us to the finish line. Discipline is the cornerstone of Buffett's investment philosophy. It manifests in various aspects of his strategy, from the careful selection of investments to the patience to wait for the right moment to act. To understand how to apply this discipline to building wealth, it is essential to grasp the principles that Buffett rigorously follows. One of Buffett's greatest differentiators is his long-term mindset. He doesn't invest with quick gains or speculative market moves in mind. On the contrary, his approach is grounded in patience and a forward-looking vision. Buffett often says, "Our favorite holding period is forever." This phrase reflects his belief that true wealth is built over time by investing in solid businesses and letting compound interest do its work. Discipline here means resisting the temptation to sell stocks during volatile times and staying focused on a company's fundamentals. A classic example is Berkshire Hathaway's investment in Coca-Cola. Buffett began buying shares of the company in the late 1980s and still holds that investment today. He wasn't concerned with short-term fluctuations, economic crises, or market trends. His discipline in maintaining this asset has generated massive returns over the decades. Another fundamental aspect of Buffett's discipline is investing only in businesses he deeply understands. He avoids companies operating in complex industries or those subject to fleeting trends. This requires self-control to avoid being swayed by opportunities that seem lucrative but lack solid fundamentals. Buffett applies the golden rule: invest only within your circle of competence. This concept requires mental discipline to admit what you know, and more importantly, what you don't know. For years, he has avoided the technology sector because he considers that he doesn't understand it well enough, even when companies in that sector were booming. This disciplined approach protects investors from making decisions based on speculation or incomplete information. For example, during the dot-com bubble in the late 1990s, Buffett was heavily criticized for not investing in technology. However, his discipline in adhering to his philosophy spared him significant losses when the market collapsed. Buffett has always warned about the dangers of speculation. Many investors are drawn to promises of quick gains, buying and selling stocks based on rumors or short-term news. However, this impulsive approach is a dangerous trap. Financial discipline requires the investor to remain calm and base their decisions on well-grounded analysis. During the 2008 financial crisis, while many investors panicked and sold their stocks, Buffett remained calm. In fact, he took advantage of the market's devaluation to buy shares of solid companies at discounted prices, such as Goldman Sachs and General Electric. This behavior was only possible because he exercised emotional discipline and did not react to the collective panic. He himself states, "Be fearful when others are greedy and greedy when others are fearful." This phrase encapsulates the importance of controlling emotions and acting contrary to the crowd when necessary, something that demands a high level of discipline. Buffett doesn't seek high dividends or immediate returns. He prefers to reinvest profits to accelerate the growth of his companies and increase the value of his investments over time. This strategy requires discipline to avoid prematurely spending profits and instead continue building the foundation of wealth. He explains that a tree bears fruit only after years of growth. Similarly, money that is invested and reinvested grows exponentially over time. It is the discipline to let money work without interruptions that allows for greater rewards in the future. Finally, Buffett demonstrates discipline by keeping his investments simple and focused. He avoids complex strategies or excessive diversification. For him, over-diversification can be a sign that the investor doesn't understand enough about the businesses they are investing in. His philosophy is clear: invest in a few companies, but invest well. This requires discipline to say no to countless opportunities that don't meet the strict quality criteria he adopts. Buffett has stated that his greatest challenge is refusing good deals in order to wait for excellent ones. If discipline is the foundation of Buffett's strategy, its practical application becomes even more evident during times of uncertainty and crisis. The way Buffett remains calm, evaluates opportunities, and acts with patience is a true guide for those seeking to build wealth consistently. Let's delve into how these principles can be applied to your financial journey. Buffett firmly believes that patience is one of the greatest advantages an investor can have. In a world where everyone seems to chase immediate results, being patient becomes a strategic edge. Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." This phrase encapsulates the idea that those with discipline and patience reap the best rewards. A classic example of this approach was Berkshire Hathaway's investment in American Express. During the 1960s, the company faced a financial scandal that sent its stock price plummeting. While the market panicked, Buffett analyzed the company's fundamentals and realized that the issue was temporary. He made a significant investment and, with patience, saw his capital multiply in the years that followed. This story reinforces the importance of staying calm during turbulent times. A disciplined investor understands that crises are disguised opportunities as long as decisions are based on analysis rather than emotion. Another manifestation of Buffett's discipline is his rigorous methodology for identifying undervalued stocks. He strictly adheres to the principle of buying shares of excellent companies at a reasonable price, rather than mediocre companies at low prices. To do so, he uses metrics like intrinsic value, analyzing the business fundamentals, management quality, and profit consistency. Buffett does not rush to buy or sell. He patiently waits until the market offers attractive prices. This self-control prevents him from overpaying for overvalued stocks, protecting his capital. A recent example was Buffett's decision to invest billions in Apple. He only began buying shares of the company when he realized that Apple had transformed from a product manufacturer into a services company with an extremely loyal customer base. The discipline to wait for the right moment resulted in billions in profits. For beginner investors, this lesson is invaluable. Don't buy something just because it's trending. Study, evaluate, and wait for the right price. Having the discipline to avoid acting on impulse makes all the difference. Buffett has always viewed market crises as unique opportunities. During the 2008 financial crisis, while many investors rushed to sell their assets, Buffett invested in solid companies that were temporarily undervalued. He purchased shares of Goldman Sachs, General Electric, and Bank of America, securing favorable conditions that earned him enormous profits in the long term. This behavior is only possible with very strong emotional discipline. Most people panic during crises, but Buffett acts rationally. He follows the principle of being greedy when others are fearful. But this greed is strategic, not impulsive. He coldly analyzes risks and opportunities. To apply this concept, an investor must develop the ability to stay calm during difficult times. Instead of panicking when the market drops, it's essential to evaluate whether good companies are being traded at unfairly low prices. This discipline to analyze and act rationally is what separates those who thrive from those who incur losses. Buffett combines consistency, knowledge, and discipline in all his decisions. He doesn't chase fads or temporary trends. His strategy is coherent and based on solid principles. This requires discipline to stay on course, even when faced with external pressures. Consistency lies in adhering to the same investment criteria for decades. Knowledge is acquired through constant reading and analysis of companies. And discipline ties these two elements together, ensuring that decisions are made logically and without emotional deviations. Buffett reads around 500 pages a day, accumulating the knowledge necessary to make informed decisions. His discipline prevents him from taking shortcuts or following the crowd. He understands that investing is a continuous process of learning and adaptation. Buffett's journey is a practical lesson in how discipline, applied consistently, is the true differentiator in building great wealth. He has shown that it isn't necessary to be a genius to succeed in investing, but it is essential to have self-control, patience, and the ability to make rational decisions even under market pressure. Building wealth is not a 100-meter sprint, but a marathon. It takes determination to stay on the right path, even when it seems slow. Buffett teaches us that financial success doesn't depend on luck or bold moves, but on disciplined choices made over time. If you adopt these principles, you'll be on the right track to transforming your financial reality. Discipline not only protects your wealth, but also accelerates its growth, creating a solid foundation for financial freedom. If you enjoyed these lessons and want to learn more about achieving financial success inspired by the great investors, don't forget to like this video and subscribe to the channel. That way, you won't miss any content that could transform your perspective on finances and investments. See you in the next video.